Hey guys, welcome back to the channel. In this video, I will discuss one of the most controversial market theories, which is the theory of options pain. Option pain is also referred to as max pain, and as the name suggests, it shows the data regarding a group of traders who are in pain. Now, this theory of option pain is a comparatively recent one and only dates back to 2004 when it was put forward. So in that sense, this is still a very young theory and there are not many supporting articles or research papers in the favor of this theory. But still, I find this a useful tool in understanding the actions of big institutions or big option sellers when it comes to manipulating the market. And I hope you, being an option buyer or an option seller, will appreciate the concept of max pain, and along with that we will also discuss the put-call ratio, which is another metric used to determine the market sentiment. So before going forward, I want to warn you that to fully understand the idea of option pain theory, it requires you to be familiar with the concept of open interest. You can watch my previous video on analyzing option chain and interpreting open interest to learn more. It would mean a lot if you liked the video and supported our effort by subscribing to the channel. Okay then, let's get started. The theory of option pain emerges as a result of a common market belief that almost 90% of options expire worthlessly during expiry, and hence the option writers or the sellers of options tend to make more money more often and more consistently than the option buyers, who are usually the retailers. But before we get into the concept of option pain, let us look at the logic behind this concept of option pain. Now, in most futures and option market, especially in India, retail traders are typically option buyers. On the other hand, option selling is majorly done by large institutions, proprietary desk of brokers, hedge funds, HNIs, etc. Now, they hedge their large positions using options and make up most of the options trading volume. Since these institutions have so much money on the line, doesn't it make sense for them to try to manipulate or even move the market to their advantage? Well, if they could, they sure would. Because these option sellers are better informed decision makers, they can write options in such a way that most of the options will expire worthless. So it is clear that the sellers are the ones who are making money. But how would they achieve this? Well, for a start, what if it turns out that if the Nifty index closes at a certain price on the expiry day, then these hedge funds or big institutions would stand to benefit tremendously? Doesn't it make sense that these hedge funds will try to move the index to that particular price level so as to maximize their gain? Obviously they would, right? This means that if the price of the option on the expiry day can be driven to a point where it would cause the least amount of loss to the option writers, this further tells us that the option prices can be manipulated, and at least at the day of the expiry. Now, considering all these, there exists a single price point at which if the market expires, then it would cause the least amount of pain to the option writers, which in turn causes the maximum amount of pain to the option buyers. So if you can identify this price point, then it's most likely that this is the point or the strike at which the market will expire. And this is precisely the beauty of max pain's theory. It helps to identify the price at which the market is likely to expire, considering least amount of pain is caused to the option writers. So, option pain is the strike price, where the maximum number of options open interest will expire worthlessly. Or in other words, max option pain is the strike where the combined open interest of calls and puts is the highest. I will make this clearer when we learn to calculate the maximum pain point. So when calculating the maximum pain value, you may find it a bit confusing, but I will make sure to clear it up with examples. The first step is to open the option chain and observe the list of various strikes on the index or the stock, starting from the ATM strike and then moving up and down to the ITM and OTM strikes. And also note down the open interest of both calls and puts for these particular strikes. Now that you have noted the open interest for each of the strike prices, we will assume that the market expires at that specified strike. Now figure out how much money is lost by the option writers. I mean for both call and put option sellers, assuming that the market expires at this specified strike price that you are looking at. Now sum up the money lost by the call and put option writers for that particular strike. Continue this process until you identify the strike at which the money lost by the option writers is the least. This level at which the least amount of money is lost by the option writers is precisely the strike at which maximum pain or loss is caused to the option buyers. Therefore, this is the price at which the market is most likely to expire. Now let us take a very simple example to understand this. For the sake of this example, we will assume that there are only 3 strikes available for Nifty in the market. Now, as the first step suggests, we have to note down the open interest for both call and put options for the respective strikes. Now, the strikes which I have considered are 15,900, 16,000 and 16,100. Now, assuming that the market will expire at 15,900, what does that imply? Remember the fact that when you write or sell a call option, you will only lose money if the market moves above the particular strike price that you have sold it. Likewise, when you write or sell a put option, you will lose money only when the market moves below the strike price that you have sold. Now coming back to this scenario, if the market expires at 15,900, none of the call option writers will lose money on this expiry. This means that call option writers at 15,900, 16,000 and 16,100 strikes will get to keep the premiums received. Since these options are OTM for a call option, this in turn means that the put options are ITM for these respective strikes. And so the put option sellers will be at risk. So let's start with the 16,100 put writers. Now, since the expiry was at 15,900, 16,100 PE is ITM and the writers of this strike would lose 200 points. Since the open interest is 32,175, the money value of loss incurred by the seller would be given by the points lost multiplied by the open interest, which in this case would turn out to be Rs 64,35,000. Similarly, 16,000 put option writers would lose 100 points and the rupee value loss that they would incur given an open interest of 58,824 turns out to be 58,82,400. Now 15,000 put option writers will not lose any money, so the loss incurred will be 0. Now keep in mind that the total money lost by call option writers is equal to the sum of the money lost by 15,900 call option writers, 16,000 call option writers and 16,100 call option writers. Likewise, the total money lost by put option writers will be equal to the sum of the money lost by 15,000 put option writers, 16,000 put option writers and 16,100 put option writers. Now to find out the combined money lost in rupees by the option writers, that is both call option and put option writers, the market expires at 15,900. It is simply given by the total money lost by the call option writer plus the total money lost by the put option writers. And this turns out to be Rs 1,23,17,400. In a similar manner, we need to calculate the combined money loss by the option sellers if the market were to expire at 16,000 and 16,100 levels on the expiry. So if the market were to expire at 16,000 level, the total money lost by call option writers will be 13,47,100 rupees and the total money lost by put option writers will be equal to 32,17,500 rupees. Then the total money lost by the sellers would eventually turn out to be 45,64,600. And similarly, if the market were to expire at the 16,100 level, the total money lost by call option writers will be equal to 1,25,27,300. The put option writers will not lose any money in this case because all the strikes below the 16,100 are OTM strikes, so the net money loss of put option sellers is 0. So the total money lost in rupees by the sellers would eventually turn out to be 1,25,27,300. Now that we have identified the combined loss the option writers would experience at various expiry levels, we can easily identify the point at which the market is likely to expire based on the max pain theory. Now, as per the option pain theory, the market will expire at such a point where there is the least amount of pain or least amount of loss to the option sellers. And undoubtedly from the table, this point happens to be the 16,000 strike, where the combined loss is around 45,64,600, which is much lesser compared to the combined loss at 16,100 and 15,900 levels. But the reality is that the calculation is not simple as this. because we have used only 3 strikes for this sample, and in reality there are many strikes for Nifty, so we have to calculate each and every strike to conclude the max pain level. Also, calculations become a bit bulky and rambling, so it is better if you get an Excel sheet that takes care of your calculation, or you can make use of the max pain data, which is represented in a more visual and graphical form on the Nifty Trader website. I will post a link in the description and it is completely free. All you have to do is to select the stock or the index that you want to check out. Now the max pain strike will be shown at the top, and it is as easy as that. You can also check the individual pain on call side as well as the put side by switching the selection option below the chart. To select any other stock, just scroll down a bit and select the stock that you want to view the max pain of. Now that you have identified the max pain expiry level, how can we use this information to our benefit? Now for a start, most traders use this max pain level to identify strikes on which they can write or sell. So in this case, 16,000 is an expected expiry level, and you can decide to write call options above 16,000 or sell put options below 16,000 and pocket all the premiums. But the problems we will face is that open interest values changes every day. Now what this means is that the option pain theory could suggest the 16,000 strike as the expiry level today, and maybe the very next day it might suggest 16,200 or even 15,800 as the expiry strike level. Now this can be a problem, and the market would expire at some other point, leaving you booking a loss, and you might start criticizing that the whole theory is flawed. So is there a way in which you can use the max pain data to gain some edge in the market? Well, there is one way which can help you make educated decisions. But before that, let me make it clear that this method that I am going to discuss applies only to option sellers. Now, the application of this theory is very limited to option buyers. And another thing that I want to mention is that this method should only be applied during the expiry day if you are a day trader. And if you are a very short-term seller of options, that is for a period of 1 week, you can also use this method, given that your holding period extends from Monday to Thursday max. I don't recommend holding positions from Friday onwards, and I leave that to your risk-taking ability. Now, using the max pain data solely for taking positions in the market is a bad move. I recommend you use price action, open interest data, and other supporting indicators to make your trading decisions. We can use this method as a feature to aid the strike selection process. Now let me explain the method for using max pain data to select strikes for trading options. This method makes use of the good old standard deviation data. Let me take the Nifty index for this purpose. As I have mentioned in a previous video where we analyzed an option chain from scratch, the options, specifically the index options, have weekly as well as monthly expiries. That opens up the fact that there are people selling options over the course of a day, a week, or a month. So it is hard to generalize max pain. So what I have done is that I have taken up the historical closing prices and the percentage change in closing prices data of Nifty index for daily and weekly timeframes. I have taken up to 15 years of data for weekly and 5 years of data maximum for daily timeframes. Then I calculated the average value of the percentage change in Nifty over all these timeframes. Then I calculated the variance and finally obtained the standard deviation of the percentage change in closing prices from the variance data. And I used the standard deviation data and the average value to find out 3 positive and 3 negative standard deviations so as to obtain a bell curve. What this curve tells me is that more than 99% of the time, the price will move within these upper and lower bounds of the average value. To be more clear, you can expect the market to give a percentage change in price within the upper and lower standard deviation limits 99% of the time. What if I use the 2 standard deviation instead of 3? Then you can have a much narrower spread between the extreme bounds, and you now have about 95% probability that the price change will remain within the standard deviation bounds. So now comes the important question. Do we really need a 99% probability? Actually not, because as the spread increases, your risk as an option seller will eventually come down, so will the rewards or the premium amount available for the take. Moreover, there are only rare occurrences when Nifty crosses above or below the second standard deviation. So a 95% surety is good enough. Now I will show you how to use this data with Max Payne to make trades backtested by statistics and not just a theory. First of all, I will explain the method for an intraday option seller during an expiry day. Please note that if you are a day trader, use it only on the expiry day. So here's the Excel data sheet for Nifty over the time period of 2017 to 2022, which is a little over 5 years on the daily time frame. Then you can see the data sheet for the period ranging from 2019 to 2022, which is a little over 3 years. And finally, the last data sheet on the daily time frame for a period ranging from April 2020 to July 2022. Now the idea here was to cover all sorts of market, a bull market, a bear market and a range market. Now I have derived the necessary inferences from the average percentage change and the standard deviation data and plotted the bell curve with values. And as you can clearly see, Nifty on an average moved 0.06% based on the first two data sheets. And from the third data sheet, it gave an average percentage change of 0.12%, which is almost the double considering a bull market was in play. But if we look at the second standard deviation data, all the data are very close to one another. So we will take the average of all the three, which comes down to 2.56%, or make it 2.6% for the second positive standard deviation and minus 2.4% for the negative 2 standard deviation. Now let's say Nifty Max Payne at the expiry day is 16,000. So as an option seller, you can find 2.6% of 16,000, which equals to 416 points. Now you add this to the Max Payne level, which will equal to 16,416. Similarly, you will have to find minus 2.4% of 16,000, which equals 384 points. Now subtract this from the Max Payne level, which comes down to 15,616. From this, you can conclude that there is a 95% chance that the price will remain between the levels of 16,416 and 15,616 at the end of this expiry day. So what you can do is you can sell a call option at or above 16,416 or sell a put option at or below 15,616 strike levels, or do both. Now most often the price won't test these levels as we know the average daily performance of Nifty, but still there is a 5% chance that the price can cross these levels from what the standard deviation is telling us. And being an expiry day, you can benefit from the decay of premiums. Now in a similar manner, let us talk about a short-term swing trader's perspective who generally holds a position from Monday to Thursday. That is, he deals with only the weekly options and weekly expiries. Here is the Excel data sheet of Nifty over a week for the last 15 years from 2008 to 2022. Then you can see the data sheet for a period ranging from 2013 to 2022, which is a little over 10 years. And finally, the last sheet on a weekly time frame for a period ranging from 2017 to 2022, which spans over 5 years. In this case too, the idea was to cover all sorts of market, bull markets, bear markets and range markets. Now, I have derived the necessary inferences like average percentage change and standard deviation data, and like before, I have plotted a bell curve with the values. And as you can clearly see, Nifty on an average moved 0.17%, 0.23% and 0.25% based on all the three data sets. Now look at the second standard deviations and let us take the average of all three. So the average positive second standard deviation turns out to be 5.2% and the negative 2 standard deviation equals minus 4.9% for a weekly time frame. Now following a similar process, let's say Nifty Max Payne on Monday shows 16,000 level. So as an option seller, you can find the 5.2% of 16,000, which equals 832 points. You can add this Max Payne level, which equals 16,832. Now similarly, you will have to find minus 4.9% of 16,000, which equals 784 points. Now you have to subtract this from the Max Payne level, which comes down to 15,216. From this, you can conclude that there is a 95% chance the price will remain between the levels of 16,832 and 15,216 at the end of the expiry day. So what you can do is that you can sell a call option at or above 16,832 or sell a put option at or below 15,216 strike levels, or do both on Monday. Now, as in the previous case, there is still a 5% chance that the price can move beyond these levels. Now, taking into consideration the short-term swing trading approach and the intraday trading approach, my vote will always go to the day trading method because we are not taking an overnight position, so the risk involved is very less. And sometimes it requires constant firefighting to save a swing trading position, and the funds required to take a position are much lower on an expiry day compared to a Monday, which means for taking a swing trading position it takes a lot more capital than what it is required for taking an intraday position. But the downside is that you will not have a very high reward, which you can obviously offset with the higher position sizing. Yet another way to gain a higher reward is by stepping down and making use of the first standard deviation data instead of the 2 standard deviation data. But in this case, the risk factor increases. Now let us move on to PCR or put call ratio. Let us learn how to make high probability trading setups using PCR. Now let me ask you something. Now as a trader, have you ever wondered what the rest of the market participants are doing at a given point of time? I know most of you will agree to this. And the put call ratio of Nifty option chain is as close to having this information as a trader. The put call ratio is a fairly simple ratio to calculate, and in a general sense it helps us to identify extreme bullishness or bearishness in market. The formula is very simple to calculate. You just have to take the total put option open interest from the option chain and divide it by the total call option open interest. Now the resulting value will usually vary within and around 1. So in simple terms, the put call ratio measures how many put option contracts are open versus how many call option contracts are open. The formula remains same whether it is the option chain of Nifty, Bank Nifty or any stock. You don't have to calculate PCR anytime. It is already available in Sensible and Nifty Trader website where it is represented in a more graphical form. Now, PCR is considered as a contrarian indicator. Hence, if PCR indicates extreme bearishness, then we expect the market to reverse and hence the trader turns bullish. Likewise, if the PCR indicates extreme bullishness, then traders expect the market to reverse and decline. Now, you may wonder why PCR is a contrarian indicator. Now, for the sake of simplicity, let us assume that everyone in the market is bearish at a given point of time. Now, because of this prevalent feeling, everyone is entering a short position in stocks, indices, and even buying puts. Now, with all the market participants bearish and now sitting on short positions, a very interesting thing takes place. There is nobody left to sell. With nobody left to sell, there is no selling pressure on the market, and the prices are starting to drift higher. Now, this drifting will eventually hit the first set of stop loss orders. Now, all these market participants will be having some sort of stop loss orders. Some will have a very tight stop loss, others will have a medium stop loss, and the remainder will use a wide stop loss. So, the stop losses that the sellers put are actually buy orders. The group of tight stop losses will be hit first, which generates a buying pressure and thereby taking the market higher. Then the medium and finally the wide stop losses will be hit until all the stop losses are taken out. Now, by the time all the stop losses are taken out, the market participants will turn bullish, and now they want to remain on the long side of the market. And once again, when everyone has bought and when there is no one else to buy, there will not be any buying pressure, and once again the market will start to drift lower. So in short, if traders are bearish or bullish, then most of them would have already taken their respective position, resulting in a very high or very low PCR value. And therefore there aren't many players who can come in and drive the positions in the desired direction. So hence the position will eventually be squared off, which will drive the stock or the index in the opposite direction. Now we can interpret the PCR based on its value as follows. So if PCR is above 1, say 1.3 or 1.4, then it suggests that there are more open put positions in compared to open call positions. But from a contrarian point of view, this suggests that the market have turned extremely bearish and therefore sort of in an oversold state. So you can look for reversals and expect the market to go up. Likewise, low PCR values such as 0.5 and below indicate that there are more call options being bought compared to puts, and this suggests that the market have turned extremely bullish and therefore are overbought. So you can look for reversals and expect the market to go down. Now you can disregard all the values in between 0.5 and 1 because they are consistent with regular trading activity. Now there is yet another way to use this indicator, and here is how it is. If the PCR ratio stays below the previous day's closing PCR, then the market is likely to be bearish, and it tells you to look for short trade setups. Likewise, if the PCR ratio stays above the previous day's closing PCR, then you can search for long trade setups. But on top of this, if you use the correlation between Nifty put call ratio and Nifty spot price, it is very useful for day trading. Now there are 4 ways to interpret the Nifty put call ratio live chart and the Nifty spot correlation. First of all, if the put call ratio is increasing during a correction in an uptrending market, this is a very bullish indication. This means that the put writers are aggressively writing at the dips. Similarly, if PCR is steadily rising during the day along with the Nifty spot price, it is also considered a bullish sign. But if the PCR is declining while the Nifty spot price moves near a resistance, it is a bearish indication and implies that the bulls are fearful of the bears and the price might reverse from the resistance level. And finally, if the PCR declines during a correction in a downtrending market, this is a very bearish indication, and it means that the call writers are aggressively writing on every rise, or the put writers are closing their positions and cutting their losses. So I hope this video provided valuable insights on max pain and put call ratio. Now I know it is a little overwhelming concept to understand completely, but it can act as a very useful tool which can give you an edge in the market when analyzing the charts for opportunities. Now that is all for this video, guys. If you have learned something new, please do hit that like button and subscribe to the channel so that you won't miss out on any upcoming videos. I will see you guys in the next video. Till then, see you.